Welcome, and thank you for joining us for today's webinar, Planning for Audit Season, What to Know Now. All participants will be placed on mute during the presentation, but during the Q&A section, feel free to unmute yourself to ask questions. You can also submit them through the question function in your webinar app. This webinar is being recorded. The recording and slide deck will be sent out within a few days. CPE credit is available to attendees who answer all 4 poll questions scattered throughout the presentation. If you are looking to get CPE, you must answer all 4 polls to be eligible. If you qualify, the CPE certificates will be sent to you via email within the next few weeks. There will be a survey that appears on your screen at the end of the webinar. Your feedback is important to us, and we want to provide you with as much value as possible through these webinars. If you would take just a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richie May, we were founded almost 40 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And now, I'd like to turn it over to our presenters today, Kelly Earhart and Kirsten Lundeen.
Thanks, Felicia. So as Felicia mentioned, my name is Kelly Earhart. I've been with the firm since 2018, and I'm just happy to be here for this webinar. You may notice a slight delay in the audio from myself, so apologies for that. It's something on my end with potentially the weather here or whatnot, so rest assured it's not on your end, and hopefully it's not too distracting during the webinar.
Hi, my name is Kirsten Lundeen, and I have been with the Richie May since 2017 and have a total of 12 years of experience in both internal and external accounting roles.
Great, so for today, the agenda that we'll cover starts with relevant accounting guidance, including ASC 842, which was that new lease accounting standard that most of you probably experienced last year. So we'll just touch on what does year 2 and going forward look like, as well as ASC 326, the financial instruments, specifically that current expected credit losses piece. Then we'll move on to issues that may arise in 2023, including debt covenant compliance, agency capital and liquidity requirements, and the going concern analysis. And then lastly, we'll touch on the importance of planning with some time at the end for any Q&A. So to start, we'll touch on the accounting guidance relevant for this year. To start with that, we're gonna look at that lease accounting year 2 specifically. The majority of our client base is the lessee, not the lessor. So we're only gonna really touch on the lessee side of these transactions. As you hopefully recall, in last year, the first year of adopting ASC 842, you would have had your implementation entries to adopt this standard, which includes bringing on your right of use asset, your lease liability, clearing out your deferred rent and any prepaid rent as well. So now moving on to year 2, now that you're past that initial implementation, your right of use asset should be amortizing monthly and your lease liability paid down as you make your contractually obligated payments through the term of the lease. So at this point, any new leases you enter into will be any new capitalizations you'll have. You won't have any large, one-time capitalization like what happens at that implementation. But the thing to maybe keep on your radar now and going forward will be any modifications to leases that you have, which would require your right of use asset and lease liability to be adjusted accordingly. So The definition of a lease modification, according to the FASB codification, is a change to the terms and conditions of a contract that results in a change in the scope of or the consideration for a lease. For example, a change to the terms and conditions of the contract that adds or terminates the right to use one or more underlying assets, or extends or shortens the contractual lease term. So some examples of what modifications could be include a lease extension, early termination of the lease, a change in the timing of lease payments, and leasing more or less space in the same building. So as you have any lease amendments that maybe you're executing on any existing lease agreement that you have, keep in mind if any of these pieces are changing as far as your lease agreement, because it may be a lease modification that then should be reflected in what you have capitalized as your right of use asset and lease liability, and may change the kind of scheduled amortization of both of those pieces. And as far as financial statement presentation and disclosures go, this will be very consistent with last year in terms of what you see on your financials. You'll still have your right of use asset and lease liability. Your lease liability is broken out into what is short-term or the current portion, and what is long-term or net of your current portion. If you've got material finance leases, that may be shown separately from your operating leases as well. Your statement of operations, again, you'll still continue to have your rent expense included in your occupancy expense line item. Your interest expense gets grouped with that interest expense line item, and the amortization of your asset should be grouped with your depreciation and amortization line item. And then with your statement of cash flows, again, same thing with what you would have seen last year, but now that we have one full year behind us and moving on to a second year, every piece of the activity in your ROU asset, your lease liability, should all flow through your cash flow statement. So if you have any one-off transaction that may be adjusted, your balance sheet side, or something had to run through the statement of ops, it may be a little tricky with your cash flows and might be worth discussing with your audit team. If you have some more questions about specifics of lease modifications or what it looks like after year one of implementing this standard, we will have a webinar that we're hosting with Lease Crunch on November 7th at noon Mountain Time. That may be a benefit for you to attend. So once this slide deck gets sent out, that link for RSVP here will be embedded in that PDF, and you'll be able to click that to register for that webinar if that would be of interest to you.
Now I am going to go over ASC 326, financial instruments, current expected credit losses, also shortened to CECL, which is effective for all of our clients that have a calendar year end. To determine if you are impacted by this guidance, some examples of the financial instruments that are included in this new guidance are loans held for investment, servicing advances, notes receivable, construction loans, receivables related to repurchase agreements, held to maturity and available for sale securities. Exceptions, which are a great benefit add for our clients, are loans over sale, 401k loans, mortgage servicing rights, derivative and hedging instruments, notes receivable or payables with entities under company control, or standards, reps, and warranties. Regarding this new guidance, our recommendations to accomplish during planning are review of your financial instruments and accounts that may be impacted by this new guidance, review of documentation regarding the methods that are used when implementing the new guidance, along with the source of the historical loss experience, adjustment to historical information, and an estimate of the CECL allowance. Additionally, reviewing entries to record the allowance for expected credit losses, and then review of the impact on the financial statements and disclosures. If you would like more information and a more in-depth look at this new guidance, Richie May did have a webinar called The CECL, Are You Ready? Which is linked in the slide deck that you will be provided. So now we are going to go into our first polling question. How comfortable are you with lease accounting year 2 entries and disclosures? First, new to me, I've heard of it, I am comfortable, or I am very familiar.
And again, this is our first poll question for today's 4 polls to get CPE. I'd like to just hold it open for a little bit longer. I can see about 82% of you have voted. So I just want to make sure that everyone has a chance to get CPE. We'll hold it open. Make sure everybody's in. And in just a moment, I'll share the results. Oh, it keeps coming up. Good. Good. I want all of you to make sure that we get it for you. Okay, I think we have close to a minute here and we have about 90% in. I'm going to share these results. 10% saying it's new to me, 30% I've heard of it, 50% saying I am comfortable, and 10% very familiar.
Great, great. Well, for those where it's new to you or you're not yet comfortable, hopefully that webinar coming up may be a good resource for you to get a little more comfortable with that guidance. All right, so now we'll move into issues that may arise in 2023. So first we want to touch on the debt covenant compliance. So we're seeing a lot of warehouse lines of credit and master repurchase agreements be amended and have terms modified, specifically those covenant, financial covenants and the calculations or thresholds. So we want to make sure that this is on your radar, that you're ensuring your calculations are in agreement with how it's written in your debt agreements with your banks. And for any financial covenants that may be unmet during the year, making sure that you're obtaining those waivers from your banks, whether that is in the form of a letter that your bank is sending you, or if it's an amendment to your agreement with your bank that may retroactively adjust a certain financial covenant for a certain quarter end or whatever it may be. Making sure you're obtaining those. That is an audit request that will be asked of you to provide if any covenants are unmet during the year. And those, as well as any amendments that are executed or any renewals, we'll be requesting copies of. And as you can see underlined, the executed version is important. We need to have the fully executed documents as part of what we need to do as your auditors. So if you have documents that maybe aren't fully executed yet, just know if you want to share those with your audit team ahead of time, just so they're aware of what might be changing, that's totally fine. But we will probably have that follow-up request to ask for that fully executed document. But these are great to start providing your audit team during the fall so that we can kind of nail down any changes in those terms that go in the disclosures or any pieces of information that we use for our analytics. And sometimes the back and forth of those debt agreements and making sure we've got up-to-date information for all of them can be a little time consuming. So a great opportunity to take care of that in the fall during your planning week or even as those are being executed. And just for your information, the specific terms that we tend to look for, whether it's because it's a disclosure in your financial statements or relevant for our testing, include the available line amount, the maturity date, interest rates, including your applicable benchmark, any warehouse margin, and if any floors are applicable with that bank, the warehouse fees, and if there's any pledged cash. And so any of those documents, again, will be relevant for your audit. We'll be requesting those. So as those are being executed, a great time to provide those to your team and making sure you obtain those waivers if necessary. Next, we want to touch on the updated agency capital and liquidity requirements. So you might recall last August of 2022, there was an update. There was a joint statement by the FHFA and Ginnie Mae, which the FHFA is the Federal Housing Finance Authority, which oversees Freddie Mac and Fannie Mae. So they came out with a joint statement updating the capital and liquidity requirements needed for your approvals with any of those agencies. The earliest of which went into effect this September 2023, and some were pushed to 2024. So hopefully it's already been on your radar, the calculations including your tangible net worth, your eligible liquidity, in any liquidity buffer if that's applicable to you. As you can see, effective at the end of this year, for our calendar year clients, there is an origination liquidity that is on top of your base liquidity if you originate more than $1 billion in a rolling 12 months. And then initially scheduled to be effective in 2023, but delayed until the end of December of 2024 is that risk-based capital specific to Ginnie Mae only. Okay, so just to look at some of these calculations for your minimum net worth for both your Freddie Mac, Fannie Mae, and Ginnie Mae, you start with the base of 2.5 million. And then for Freddie Mac and Fannie Mae, you add on 25 bps for all 1 to 4 family loan serviced, whereas for Ginnie Mae, you're going to add on 35 bps of that portfolio. For the minimum capital ratio, this calculation is the same for both the FHFA and Ginnie Mae, and that's going to be your tangible net worth divided by your total assets needs to exceed or equal 6. Your base liquidity for Freddie Mac and Fannie Mae, you're going to start with the you're going to have 3.5 bps of your agency portfolio. Although I do want to specify if you have any remittance structures that are not that are scheduled to schedule or scheduled to actual, those require 7 bps instead of 3.5. So just depending on what that remittance structure looks like for any of those agencies for you. And then Ginnie Mae is 10 bps of the Ginnie Mae portfolio. Now for your origination liquidity, like I said, that's only if you originate 1 billion in production in a rolling 12 months. So as your production levels clearly fluctuate throughout the year, you may hit this certain quarters, but maybe not all. So we recommend just calculating this additional liquidity requirement, which is 50 bps of your loans held for sale plus your pull-through weighted interest rate lock commitments. We just recommend completing this calculation every time you're doing these, just to ensure if you are going to reach that 1 billion threshold at any 12-month end down the road, this isn't something that's fallen off your radar, but that you do have kind of in your routine to calculate and be on the lookout for. And then just to touch on, if most of our client base is not going to be considered a large non-depository, but if you've got 50 billion or more in single family servicing, then the liquidity buffer and the capital and liquidity plans will be effective for you as well. Okay, and then just some specifics for the tangible net worth calculation for both FHFA and Ginnie Mae. These are very similar calculations. For both, you start with your total equity, and then you back out your goodwill, your intangibles, affiliated receivables, and pledged assets net of associated liabilities, as well as deferred tax assets net of deferred tax liabilities. And then you'll see bolded here under the Ginnie Mae portion that valuation adjustment of certain assets. So we want to specify that this doesn't necessarily mean your MSRs, but we've had a number of clients have questions on that piece. And so we contacted Ginnie Mae to get some clarification. And based on the communication we received back from Ginnie Mae, at this point in time, this valuation adjustment of certain assets is to their discretion. And so they'll let you know if there is a certain valuation adjustment that they want you to back out for this calculation. So we recommend if you're not sure and you just want to make sure ahead of time to contact your Ginnie Mae rep specifically. But unfortunately, at this point in time, there is not a designated list of this is included, this isn't. Like I said, it's just kind of to their discretion. Okay, so now we're going to just look at the eligible liquidity calculations and the allowable assets that can count towards this. So for Freddie Mac and Fannie Mae, your allowable assets include your unrestricted cash and cash equivalents, unpledged available for sale or held for trading securities, and then 50% of the unused portions of committed agency servicing advanced lines of credit. On the Ginnie Mae side, you again start with your unrestricted cash and cash equivalents. You can have any AAA rated government securities marked to market, any agency mortgage-backed securities marked to market, obligations of government-sponsored entities marked to market, and any P&I, T&I, and foreclosure advances. So as all of these calculations have updated or maybe tweaked a little with that update and have become effective this year, just keep that on your radar, and you'll see some of these, impact those schedules at the back of your financials as well this year. All right, so now we're going to move into our second polling question. So this question is, how comfortable are you with liquidity requirements? A, I am not good, very uncomfortable. B, a bit uncomfortable. C, I am very comfortable. Or D, very comfortable, on my way.
Okay, we have people voting faster this time, which is great. Again, we want to make sure that you get your CPE. So please vote while the poll is open. We will wait about 15 or more seconds here to make sure everybody who got in on the first time gets here again. Thank you. I can see a lot more votes coming in. I'm going to hit that 90% again, close to. So we need just a few more people to vote. All right, happy to share these results now. Okay, it looks like everybody's in. I'm going to close this poll and share the results. Just 5% are saying I'm not good, very uncomfortable. So good that we're here talking about this today. And 38 is a bit uncomfortable. So maybe we spend some time talking about this. 38% is I am comfortable, and 18 is very comfortable, on my way.
Great, yeah, good to know. And for those of you who maybe are very uncomfortable or just a bit uncomfortable, or even, just want to gain a little more comfort over calculating these updated requirements, Richie Mae does have a template built out that Seth and Jordan did earlier this summer when they put on a webinar going over this information. And so if that would be of benefit to you, please reach out to us at Richie Mae. We'd be happy to share that. It's just for the value of our clients. So yeah, that is available for you if you would appreciate that resource. Okay, great. So last of the issues to keep on your radar for 2023 is going to be the going concern analysis. So management must evaluate the entity's ability to continue as a going concern. This is management's obligation and responsibility to perform this analysis. A good question to ask is the entity able to meet its obligations as they come due within 1 year after the date the financial statements are issued? Management's evaluation should address whether there are conditions and events in the aggregate that raise substantial doubt about the entity's ability to continue as a going concern. And if substantial doubt is found, even just a small amount of doubt, but if it's there, it will impact your audited financial statements. will impact both your audit report and the disclosures, and just depending on the severity of the circumstances, raising that substantial doubt in what is management's plan to mitigate it, kind of varies then what that impact will look like in your financial statements. So if this is something that, you've hopefully had, conversations internally regarding your upcoming projections for the year, and you may know that this might be something that could be a concern to your audit team, we recommend start that conversation now with your audit team so that we can start to have those discussions and get on the same page as early as possible, because, obviously it's always better to get any of these things nailed down even before season starts, or even at least have a good idea going into season, rather than right at the end when you're trying to issue your financial statements. So yeah. When it comes to performing your evaluation, you want to consider both qualitative and quantitative information of the following factors, and this is both as of the date the financial statements are issued and within 1 year of the financial statements being issued. So really you should be thinking about these things all the way through Q1 of 2025 for those on the calendar year end. So these factors include your current financial condition, including liquidity sources, your conditional and unconditional obligations due or anticipated, funds necessary to maintain operations considering its current financial condition, obligations, and other expected cash flows, and other conditions and events in conjunction with the above. And as far as what might be some of those other conditions and events, that could include negative financial trends, recurring operating losses, other indications of possible financial difficulties, for example, defaulting on loans, internal matters, maybe work stoppages or other labor difficulties. External matters could include legal proceedings, rising interest rates, loss of investors, or natural disaster. So many of us are experiencing, that external factor of rising interest rates, but it's not just one factor that you want to consider. It's remember that phrase, in the aggregate. So you need to be evaluating of all of these different factors, what are causing challenges in our entity, and cumulatively, does that raise substantial doubt of the entity's ability to continue as a going concern? And just be prepared that your auditors are going to want to see this, ask for your analysis, have this conversation with you. So ideally, if you are doing or maybe can start to do a projection or forecast of your next operating year up through Q1 of 2025, as well as add some context to what those figures are showing. To support, we will be able to continue as a going concern, or maybe there is doubt, but here's our plan to mitigate that doubt. Yeah, just be prepared that that will be a topic of conversation this year again as part of your audit. So now moving on to polling question number 3. This polling question says, where are you in the going concern analysis process? A, have not started, B, performing review of financial trends on a regular basis, or C, detailed analysis with future cash flows and comparison of projection to actual.
Okay, we have the votes coming in a lot faster this time, which is wonderful. And again, we want to make sure everyone gets the CPE that they would like. So please take a moment to vote. And that's why we're here today, to make sure we can talk through these items. So it's helpful to know where you are. Okay, just a few more people need to come in to make sure that we get your CPE. Keep it open for just a few more seconds. Get those last people in there. Thank you for all these votes coming in. I'm going to go ahead and close the poll and share the results. So about a third have not started. About half have done the performing review of financial trends on a regular basis. and 17% have done the detailed analysis of future cash flows and the comparison of projection and actual.
Great, awesome. So yeah, sounds like a lot of you are on your way to having good documentation for this piece of your audit. And for those that have not started, never too late to start. You can always, reach out to your Richie May team for, certain advice or maybe ideas of where to go. But of course, this is management's evaluation and responsibility. So we can't tell you exactly, what you need to be looking at, or obviously, no one knows the operations of your entity as well as you do, but yeah, hopefully this will give you some insight as to where to begin, and yeah, be prepared for this next audit.
Kristen, you're on mute.
Thank you. Sorry about that. So I'm going to go over the importance of planning. Planning, also called interim, is a key piece of the overall financial statement audit that enables the current year project to be set up for success. And I'll be going over the 5 crucial aspects of interim procedures. First one is the preliminary analytical review, sometimes shortened down to prelim or prelim analysis. So the preliminary analytical review is one of the most vital portions of the planning process and procedures, as it allows the audit team and you to have a discussion regarding changes that have occurred during the year and determine if further procedures or discussion are necessary. The main sources of the information are both internal and external. For internal, what do we gather from you? This is going to be the trial balance and related account groupings, year-to-date production, full-time equivalent employees throughout the year, and number of branches. For information that we obtain externally to you or internally to us, is going to be industry information and expectations based off of our RM Select information, knowledge of the industry, and your main production channel. So what does this process look like before we send it to you? So we are taking both the internal and external provided information to create a detailed comparative analysis based on the change in dollar amount and percentage, expectations based off of past knowledge and current state of the industry. Some examples of information that we look at as part of this analysis and are added to the discussion agenda are the purpose of new accounts, reason why accounts might have flipped signs. They might have been a debit last year and a credit this year, or vice versa. Significant change in the fair value percentage of loans over sale outside of industry expectations, and change in interest margins outside of industry expectations. Overall, what is the benefit of this analysis? If a detailed and complete preliminary analytical review is performed during the interim procedures or during fall, the audit team can refer to the discussions during the fieldwork portion of the audit for any changes noted during the year-end information. Therefore, instead of responding to requests of changes in the accounts for the entire year, you might only have to respond regarding accounts that have significantly changed during the fourth quarter of the year. Additionally, more detailed discussions that require more time, research, and review can be completed when both teams potentially have more availability. And it helps to continue to strengthen and reaffirm relationships between the teams, making sure that we understand communication styles and what can and should be provided during planning procedures. Next, I will go over the other 4 key planning procedures. First one being, what is the impact of compliance on planning and on the overall audit? The impact is that the team that is addressing compliance-related requests might be different than those who are responding to financial statement audit requests. However, I want to stress the importance of these procedures. The impact of compliance on the overall audit is that recommendations can be included within the management letter, depending on the impact. And compliance procedures, if not completed, could potentially delay the finalization of the financial statement audit. The key piece that causes delays in the finalization related to compliance is that compliance testing has key pieces of information needed for supplementary schedules and reports, including the agency capital and liquidity requirements that Kelly discussed. The next key part of planning procedures are one-off transactions. Examples of these are, did you have an acquisition or merger, an MSR sale? Are you discontinuing or selling a portion of your business? These are just some of the examples of one-off transactions that could create a perfect opportunity to discuss with your audit team during the planning procedures. For a little bit more of a detailed example of the impact of one-off transactions, looking at the information and discussions regarding an MSR sale. Do you have a full and complete sales agreement that includes all information needed to verify sales accounting and that it qualifies for sales accounting during the current year? Have you recorded the initial sales entry with holdback receivable and payable amounts? And are subsequent transactions recorded and supported for any release of the holdback balances or loans that were not able to be sold? Next key part of planning procedures are, did you make a change or are you planning to make a change during the current year that may significantly impact the audit? Some of the examples of changes in operations and change in estimates that we would love to discuss with the team are, did you change the key audit contact, entity type, loan origination system? For the loan origination system, how is the account and information migration process going? When is your expected go live date or official approval date? Change in estimates. Are you changing the valuation method or third-party valuation company of your MSRs? Did you change the BIPs of production for your determination of the loan loss reserve? What is your purpose and intent behind the change in estimate? What information did you use to determine that the change was appropriate and needed? Overall, what is the benefit of planning? Benefits of discussing and testing of one-off transactions during planning is that you are aware of any additional information needed to be gathered, recommended updates, documentation, potential entries before year end, and the fieldwork portion of your audit. Plus, a review of the impacted footnotes to make certain that the impact and the language is agreed upon before the drafting process of the audit. When we get to the drafting process of the audit, it can be a lot more stressful because of the time crunch with the deadline. So we highly recommend having those discussions during planning, reviewing those footnotes, and making sure both teams are in agreement of how that information is communicated within the audited financial statement report. And lastly, planning procedures during the fall are a perfect opportunity to have additional trainings, data verification testing, and discussions. We want to work with you as part of your team and limit any unexpected procedures or recommendations as much as possible.
Hey, Kirsten, thanks so much. Hi, everybody. This is Christina Lucas. I'm an audit director here at Richie May. Just going to jump in and kind of touch upon some of these items that Kirsten and Kelly did a lovely job going over with you guys. I think what we're noticing this year as we're initially starting our planning calls for these audits is we are aware of how this year is going, and we're trying to be as delicate as possible, knowing that, you know, this is our full-time job. Oh, my camera's on. Sorry, guys. Hi, everybody. So we're trying to be delicate in maneuvering through our audit procedures and questions that we may ask during this year. They are our standard questions and procedures that we go through year after year. Just some of these will seem a little more drilled down this year, just because how this industry went for 2023. So if you're feeling uncomfortable or having some frustrations, please let us know. Please rope in management, because that's not our intention. We do realize that you guys do have full-time jobs, so we try not to be, you know, too up in your business to create any complications or hopefully not put you behind in your own work. So as our team is going through planning, that's kind of the relationship we're hoping to build as we head into year end, kind of a two-way, hey, let's work together on this. Yeah, so kind of touching that on planning. With one of the items that Kelly was bringing up, the going concern. So this is usually a couple questions we ask every year, and every year it's kind of breezed over just because it's been profitable years and we haven't had to be concerned if entities would be here within a year of our report issuance date, because in our audit report we have to give an opinion on that. So Kelly drilled that down in this particular seminar just because if we're having to look at that with a little more fine-tooth comb this year, that's why. So in our audit report, we have to give that opinion on, yes, we're giving an opinion on these financials and the notes with the financials that this entity will be here within the next year of the issuance date. So if we're issuing a report in March, we're saying by next March 2024. If there is no substantial doubt that an entity would be able to exist in the next year, there's no disclosures or any change in the audit report. It's a done deal. You give us the support, we don't see there's a substantial doubt to continue as a going concern, and that's done. There's no notes in the footnote. We ask the questions, we do the analysis, we have that documented. You guys do the analysis, we agree, and then that's done. So if some of you guys are concerned, I don't know which way this is going to pan out, I don't want my audit report to change. There could be a dead end with that because there's kind of a step process here. So let's have that conversation during planning to kind of see where things are shaking out, to see where they might go by the end of the year. So there's no kind of surprises at the end of the year, because we don't want to, you know, be over aggressive with it if we don't have to, if that makes sense. The second year lease accounting, I know Kelly made that plug for that webinar that's coming in a week or so, just to knowing how to handle those lease modifications, renewals, or terminations. That would be also something we go over in planning. So let's make sure we get that worked out before the end of the year so there's no adjustments, because we're trying to, you know, not have those adjustments at the end of the year, just to make that process a little smoother. And there was one thing, servicing advances on CECL. Sorry guys, I have some notes and I was writing quickly, so not as legible as I would hope. Depending on what's going in those servicing advances, the pieces that make up that account, CECL model could apply for that if there's a credit loss exposure in that, but for like a non-recoverable piece, that might not have the CECL model apply. So when Kirsten's saying this applies with servicing advances, have that discussion with your audit team, because depending on how you have your chart of accounts and what's going in each specific servicing related advance account, CECL could apply or not apply. So let's make sure we have that conversation this fall so there's no kind of, you know, surprises at the end of the year. Kirsten and Kelly, not to put you guys on the spot, but if you could think of like 1 to 2 key takeaways from this webinar that you might want to touch upon with our viewers, can I kick it over to Kelly? Do you have enough time? I'm giving you about 30 seconds to do this. For guys.
Yeah, of course. So I would say my 2 takeaways that if you leave this webinar, that I would hope that at least maybe sticks with you is 1, just be prepared for that going concern analysis. You know, as Christine was saying, hasn't been as big of an emphasis historically, but just with the state of the industry is becoming something that we need to make sure we do our due diligence on as your audit team. So, so just be prepared for that to be requested and discussed. And my other takeaway is for those updated agency requirements, the liquidity and capital, those updated calculations. Remember that we have a template if you would need that, or if that could be helpful for you, and we'd be happy to share that with you.
Thanks, Kelly. Like Kelly was saying, my recommended takeaway for this webinar is that planning is a perfect opportunity to have discussions with us. We want to be part of your team, and we want to have those calls, those emails, those review of information, so that, like I said, there's no surprises. It's a perfect opportunity for everyone on the team, from staff to partner, and people outside of our department, such as Seth Sprague, to join our conversations and make sure that we are all have the same understanding, and that we are set up for success when we have to move a lot faster in the first quarter of the next year. And then I will kick it over to Christina for any parting thoughts.
As you were talking, I just thought of one thing that you mentioned during planning that I thought was really important. We've actually met as a leadership group discussing this, and I don't know if you guys are seeing this in your companies as well, of communication preference styles. So if you guys prefer phone, I'm a phone call person. Like, let's get on the phone, hash it out, be done with it, and move on. But if you don't have time to carve that out of your week, please let our team know, and we will gladly, go through SureLink, go through email, however that communication preference and works best for you. Let us know, because we are flexible. This is our full-time job, so we can make it look however you want it to look for yourself, because I know you're tacking on an audit on top of your job. So let's make sure we know what you guys are expecting or prefer, because again, we don't want that frustration on your side if we're blowing up your emails every 2 seconds and it's like, what is happening here? I cannot handle this. Send me one email at the end of the day, or let's just jump on a call every day, and that's your preference. We'd gladly be able to do that with you guys if you give us that opportunity. So I just wanted to add that in there. Remember, that was a bullet point of, let's talk about that, because I think depending on what's going on with your week and stuff, we'd like to know and be here to help and make this process as smooth as possible.
So with that, we are going to go into our final polling question. What is the one area of planning that is going to be your focus this year? A, preliminary analytical review. B, one-off transactions. C, compliance. Or D, change in operations.
Again, votes coming in super fast, which is great. This is our last poll question to get your CPE. And we want to make sure we have some time, because we do have a couple questions that have come in. And it looks like we're getting almost everybody there. I'll wait a few more seconds. Again, this is the last question to make sure that you get CPE today. Okay, looks like everyone is in. I'm going to go ahead, close, and share the results. So 53% are doing the prelim analytical review, which is awesome. 11% are at one-off transactions, 31% with compliance, and 6% change in operations.
This is great. I love all the people saying preliminary analytics and compliance, and we look forward to working with you on both of those aspects. And I think now we are going to open it up to any questions that anybody might have.
Well, speaking of, we do have one question in that I'll launch to the three of you. Speaking of preliminary analytical reviews, the question is, who should be involved in the preliminary analytical review discussions?
Great question. The recommendation would be the key audit contact, so that's usually the CFO controller. It's also recommended that if you have anybody else within your team that oversees a key transaction cycle or certain accounts, that they also be involved in reviewing the questions about those accounts and being involved in those conversations to make sure that if we have any follow-up questions, you don't have to have a separate meeting to follow up with them.
Just a reminder to feel free to unmute yourself to ask questions, and you can also submit them through the question app in your webinar app. But we do have a second one right now. Can you go over the definition of going concern? I know you spoke to it a little bit, but if we could review that again, that'd be great.
All right, Felicia, can I backtrack a little bit before that question?
Sure.
Okay? For being involved in the preliminary analytic phone call, if there's a preference, just again, preference-wise, if you want to see that report or comparison, from last year to this year before that phone call, please let our team know. Some people like to see that, take the time to have the answers and responses in time for that call. Some people like to discuss it in real time during that call. So if you prefer one way or the other, please let our team know, and we can definitely, you know, work with you on that and make sure that report's available in advance if that's, you like a heads up on that, or if you're just like, let's do this in real time, we like to do that too. So whatever works best for you, we can definitely accommodate.
Fantastic. And now could we go back to just reviewing the definition of going concern again?
Yeah, certainly. So this one gets, it trips up a lot of people because you hear concern and that sounds concerning. But the phrase ability to continue as a going concern means, collectively, it means the business will continue to be in operations. So if your company can continue as a going concern, that's a good thing. That means you're planning on sticking around. It's when you have doubt about the ability to continue as a going concern. That means maybe there are certain challenges, things are getting hard. We don't know that we'll be around in 1, 2, 3 years, what it may be. So definitely trippy to get used to, but yeah, in total, being a going concern, continuing as a going concern means you anticipate continuing as a business.
Thank you so much.
I think it does get confusing because we usually aren't talking about this, and people will shorten that. And they won't just say, oh, substantial doubt of ability to continue as a going concern, because that is a lot of words, and we're numbers people. So we'll shorten it to, oh, there's a going concern, or oh, there's substantial doubt. So really understanding of, no, we're good. We're saying you're able to continue as a going concern. That's a positive, good thing. So if people shorten it and you're not sure which way it's going, let's make sure we're on the same page with that. Because I think sometimes as auditors, we're numbers people and we don't want to say 10 words. We'll just shorten it to 2. But mortgage industry, you're used to acronyms. So similar, maybe, right?
Great. Thank you so much to our presenters. Again, any other closing comments? That's it for the questions that have come in so far today. As a reminder to the audience, you can send us questions after this, but do we have any other closing comments before we end for today?
No, I think we just want to thank you all for joining us on this webinar, and we look forward to our next communication.
Yes, Kelly, if you could go to the next slide. Just again, to thank everyone for coming. Here's our contact information. info@richiemay.com is the place to go with any questions regarding this, and we'll make sure that it gets to the right person if you don't remember exactly who is your contact here at Richie May. But please reach out and we'll see you next time. Thank you so much, and this will be coming out to you within a few days. Thank you all.